Good morning, everybody. Welcome. I'm Yannicka Ratcliffe, Vice President of the Housing and Communities Division at the Urban Institute. And I am so very happy. I welcome you all here today to the second in a series of webinars around GSE recapitalization. If you missed the first one, I'll be posting the link in the chat and encourage you to watch that. I also want to do a special thank you and welcome to our guests, Stephen and Byron and Michael and Warren. Thank you so much for joining Laurie Goodman today in what promises to be a really valuable hour of our time in which we will all get a lot smarter. So before we dive into that, I will need to take care of a few housekeeping items. This event is being recorded and the recording will be posted online afterwards for viewing and sharing. You can find out more about each of our speakers online at the event website. You will all be muted during this call. You can type questions and comments into the Q&A box at any time. We may not even get to all of them, but we really appreciate hearing what's on your mind. This can inform as well future events in this series. And then we'll have a survey at the end that we invite you to complete as well. So with that, I will turn it on over to Laurie.
I'm having trouble starting my video, sorry. Thank you all so much for joining. Really pleasure to see so many of you here today. I'm going to actually do a short 10-minute or so presentation on why we should care about this. Why my video isn't starting. Okay, I'll go through my slides and then I'll switch screens. We're going to talk about the impact of mortgage rates on the mortgage rates and the MBS market, and in particular, why the mortgage-backed securities market is so important for mortgage rates. So with that, let me actually start. There are actually three components to mortgage rates. There is the base 10-year Treasury rate. There is the secondary market spread, which is the difference between the 10-year Treasury rate and the rate demanded by mortgage-backed securities investors. And that is determined by three components. Prepayment costs, that is, 30-year mortgages are freely prepayable. They tend to prepay more frequently when rates are low, so investors get their money back exactly when they don't want to get their money back, and they tend to prepay much less frequently when rates are high and the investment opportunities are very, very good. That property is oftentimes referred to as negative convexity, but that is definitely a cost of these securities to investors, which demands wider spreads over treasuries. There is also supply and demand considerations, the supply and demand for these MBS securities, and also liquidity considerations. The primary secondary spread is the third component, which is the difference between the mortgage-backed securities spread and the mortgage rate paid by borrowers, which is determined by the GSE guarantee fees, servicing costs above the ordinary, and originator profitability. The base Treasury rate plus the secondary market spread plus the primary secondary spread is essentially the rate paid by the borrower, and that governs affordability. So this just shows you what the pattern through time has been. And so at the time we did this 681, the 30-year fixed rate mortgage rate was 681. The MBS coupon rate was about 589, and the 10-year Treasury rate was 458. So, you can see how each of these spreads is really important. And we're going to dive a little bit deeper into each of the components. So this just shows you the mortgage spread over treasuries is about 237 basis points now from or a couple of weeks ago from the previous picture. It had been as high as almost 300 basis points. Of that, the secondary mortgage spread's about 135 basis points, and the primary secondary spread is 102 basis points. You'll notice that the spreads are much wider than they've been historically. That is, that 237 basis points, while it's definitely down from where it was, is much wider than it's been historically. The secondary market spread, that is the orange line that reflects the supply and demand considerations for these securities, is actually wider than it has been sort of since, on average, since 2010. That it is on the very wide side of where it's been historically in recent memory. The primary secondary spread is wider than it was in the early 2000s, but certainly, kind of in line with where it's been sort of in the post-2010 period. The reason the primary secondary spread is wider than it's been in the early 2000s is in large part because guarantee fees have gone up through time, as you're all well aware of. So let's actually take a deeper look. As I mentioned, guarantee fees are a part of the primary secondary spread. This just shows you, so the question is, if you release these entities from conservatorship, what sort of rate, how much of a rate of return would private investors be able to obtain? That is, would there be a utility model with a 10% after-tax type rate of return, or would investors be entitled to receive a market type rate of return of 13%? If you look at the utility type rate of return, you can see that the GSEs would be about 76 basis points. Under a market rate of return of 13%, GSEs would be about 91.5 basis points. This is about, so under the utility type rate of return, it's about 10 basis points wider than current levels. Under the market rate of return, it's about 25 basis points wider than current levels. So, private capital, bringing private capital in does mean private capital has to earn a market type rate of return. And the question is, what is that market type rate of return? Is it a utility return, or is it a true market return? And that will definitely have an impact on GSEs of on the order of 10 to 25 basis points. Now let's delve into supply and demand. Who owns agency mortgage-backed securities? If you look at this slide, this shows you that of the mortgage-backed securities that are outstanding, 35%, or this of the agency mortgage-backed securities that are outstanding, that is Fannie, Freddie, and Ginnie. U.S. depository institutions own 35% of the total. In this world, commercial banks are the behemoths of this market at about 28%. The Federal Reserve System is at 25%. Foreign investors are at 4.5%. Mutual and money market funds are at about 13.4%, and everyone else together is around 12% of the market. So you can see that 75% of the market are owned by the top three institutional types: U.S. depository institutions, the Federal Reserve, and foreign investors. This shows you how it's changed through time. And you can see in particular that over the last couple of years, depositories have become have been less inclined to grow. They grew their commercial back holdings very, very rapidly in the 2009 to 2022 period. They've been less inclined to grow their MBS holdings, and in fact have contracted their holdings over the last couple of years. Meanwhile, the Fed was extremely active during COVID, growing their portfolio very, very rapidly, and has since letting their portfolio run off. Foreign investors have been fairly static in the market. They've had their ups and downs, but they've been pretty static. So the question is, what happens the question is, what happened? What are the potential impacts on supply and demand of a recap and release? So there are a number of things to consider. The first is downgrade risk. That is, how important is the implicit guarantee and the Treasury line of credit? How do investors view that? What is the potential for downgrade? And we're going to explore that in the panel discussion. Bank capital rules and concentration limits are also quite important. Banks have very favorable capital rules for holding mortgage-backed securities. They also have, agency MBS is also exempt from concentration limits. That is, they don't have per name limits the way they do for other corporate names. Question, what happens to the Federal Reserve purchases? Remember, the Federal Reserve owns 25% of the market. They've been really important during certain periods. Currently, they're letting their securities run off, although they were running off very slowly. What happens in future crises? Will they be able to buy? And is this dependent on the potential for recap and release? And finally, what is the impact on liquidity? Because many investors like the fact that these securities are so liquid. Let's explore the liquidity a little bit more now. If you look at this picture, thank you, SIFMA. This shows you the average daily volume of Treasury securities, corporate bonds, and agency MBS. You can see that agency MBS has about 300 billion a day of trading volume. For Treasury coupon securities, it's about 700 billion a day, and for corporates, it's extraordinarily low. If you look at the trading volume as a share of outstanding securities, you can see both corporate bonds and Treasury securities. You can see both agency MBS and Treasury securities have turnover in the neighborhood of around 3.5% per day. That is, turnover is about 3.5% per day on total outstanding volume. For the corporate bond market, it's less than 0.5%. What does this mean? This means that it is very, very cheap to trade these securities. For agency MBS, it's 1/132nd of a point, or 3 cents per $100, $312.50 per million. For treasuries, it's about half of agency MBS, half of a tick, that is a half of a 32nd of 1 point, or about 1.6 cents per $100, or $156 per million. For corporates, it's 14/32 of 1 point, or about about 44 cents per $100, or about $4,400 per million. It's important to realize that it's much more expensive to trade corporates than it is either agency MBS or Treasury securities. It's important to realize that mortgage trading volume is very high due to the existence of a TBA market that allows originators to hedge their origination activity, even though the mortgages won't settle for a month or two. So if Yannicka takes out applies for a mortgage today, as a mortgage company is able to lock her rate because they're able to sell her mortgage forward into the TBA market. And this aspect is very important, because without it, the mortgage originator would be exposed to rate fluctuations for a couple of months that they may or may not be willing to take. So the TBA market is extraordinarily important as a hedging vehicle, and it allows borrowers to lock their rate. So with that, we've seen that bringing the GSEs out of conservatorship is going to increase G fees in the range of 10 to 25 basis points, as investors will demand a higher rate of return. The impact on supply and demand and liquidity is more speculative. It depends on the form of the recapitalization and how it is perceived by market participants. And to better understand these potential impacts, we're going to turn to our expert panel. So with that, let me introduce our panel. We have Steve Abrahams, the Managing Director and Head of Investment Strategy at Santander U.S. Capital Markets. Byron Boston, the Chief Executive Officer at Dynex Capital Inc., Michael Bright, the Chief Executive Officer of the Structured Finance Association, and Warren Kornfeld, the SVP of North American Banks and Finance Companies at Moody's Ratings. Thank you all for joining us. And you can actually, all of these guys have fabulous bios, and you can read more about them. You can read more about them in the chat. So what I'd like to talk about is the impact of recap and release on the MBS market and why it matters so much. We're going to talk about the implicit guarantee and treasury line of credit. We're going to talk about the impact on specific players. We're going to talk about liquidity, and we're going to talk about the impact on private capital and the government footprint, as well as on the Ginnie Mae market. So with that, let me start with Byron. You're the CEO of a mortgage REIT, a mortgage real estate investment trust that makes leverage investments in agency MBS. Why is the agency MBS market so important to both borrowers and investors?
Thank you so much, Laurie, for having me this morning. It's extremely important, and let me emphasize that I've traded mortgage-backed securities since January of 1987. And I've gone through every cycle since that point in time. And I can't say enough and emphasize enough that one of the greatest parts of America is our housing finance system. And our savers enjoy great benefit. Our borrowers enjoy a great benefit. So as I approach the question around the GSEs, I don't start from a perspective that something is necessarily broken. I understand that there may be many people who have various ideas around how the system could potentially work. But at Dynex Capital, it's key to understand that we have two key constituencies that are benefits. It's the borrower, who ultimately has no cash to buy a home, and the only place they can get cash is from the savers. Mortgage originators don't have cash, banks don't have cash, savers have cash. The savers buy Dynex Capital stock, and we ultimately move that cash through the system, ultimately to the American homeowner. And the way that the key vehicle to making that work is the agency mortgage-backed securities market. All non-agency mortgage-backed securities trade off of this core sector, and liquidity is extremely important, and that liquidity is heavily influenced by the government's role in the mortgage market. And because of how well our home system works, our economy works better. Think about the amount of Americans who have 30-year fixed rate mortgages. Think about how many of them have a mortgage below 4%. And so it becomes a great asset for our country in the short term, over the long term. The liquidity is extremely important to us. We are leveraged. We provide a higher dividend yield to our shareholders than you would get from an average US stock. So therefore, our savers are really benefiting. But we would not take as much risk if we did not have the opportunity to have a liquid security to invest in with the type of spread that you clearly showed in your slides, spreads above treasuries. We would be stuck with just treasuries, and we would not be providing that large of a benefit. Understand that in this day and age, with so many baby boomers needing so much income, this agency mortgage-backed security is providing an enormous amount of benefit to not only the savers, but also to the American homeowner. And at Dynex, we play a role between the two as experts in terms of managing the risk. Don't take for granted 30-year fixed rate mortgage, prepayable at any point in time. It's the only place in the world where a homeowner has this type of option to own a home in this manner. Rarely will you find those type of benefits in any other country.
Thank you. With that, let's move on to talk about the implicit guarantee and the treasury line of credit. The GSEs cannot be released from conservatorship without with an explicit backstop without Congress. If it were to be released administratively, at most it would be with the PSPA line of credit intact and possibly paid for. Since this is a key starting point for the discussion, let's start here. Warren, you rate Fannie Mae and Freddie Mac on behalf of Moody's. How do you rate the GSEs today, and what would change upon an exit from conservatorship?
So thanks, Laurie, and thank you very much for inviting me. As always, just phenomenal slides. So Today, two companies in conservatorship. FAFA functions, as a company's shareholders, directors, officers. Treasury also owns 79%, 0.9% of the companies through warrants. We assume, and we only rate the unsecured debt. We don't rate the MBS. We assume the unsecured debt is government backed, even though, Laurie, as you said, there was no explicit guarantee, beyond the PSBA support. Therefore, our rating on the unsecured debt is equal to that of the U.S. government. Now, if we move beyond as far as post a conservative exit, we would likely reduce their expectation of government support, and that's implicit support. So today, once again, how do we rate them? We rate them on implicit support. So we would likely reduce that expectation, but a reduced likelihood does not mean no likelihood of implicit support. We put out a report earlier this week, refreshing our views, what we had said the last go round about 4 years ago. So if we do downgrade the unsecured debt, and I emphasize if, we still expect the unsecured debt to be highly rated. And then any downgrade likely would be no more than 3 notches, so AA or higher. Now remember also, the MBS outstandings dwarf the size of the unsecured debt. The MBS is 7.3 trillion outstanding today. The unsecured debt has come down materially as post GFC. The investment portfolios were mandated to decline. It was just 270 billion of unsecured debt. So we first off, we really do not think that Treasury and FAFA would allow an exit unless the market continues to view the MBS as effectively government-backed. So yes, for the MBS, unlimited implicit support. So how will we rate the companies? How we rate the unsecured debt? And how do we arrive post conservatorship, and how do we arrive at that AA rating? So instead of the top down, it would be a bottom up. We'd likely use our bank methodology. While these are not depositories, we still believe that they have bank-like regulatory capital requirements. They're financial institutions. They have prime assets. We apply our bank methodology, and we rate the federal home loan banks and the foreign credit banks. The first step is we apply a standalone assessment where we assume no government support, no implicit, as well as no explicit support, so not including the other PSBA. And a standalone assessment is a probability of default or the probability of failure. As a reference point, the federal home loan banks and foreign credit banks have A1 standalone assessments. However, Fannie and Freddie, they have a track record, they're much more concentrated businesses. So assuming that we don't see, assuming one, they're at their statutory core capital leverage requirement. And note, this is the only capital requirement that is fully defined in statute. That's a little bit lower than the numbers that Laurie was showing up on her slides as far as a 4% capital. This is a 2.5% on balance sheet and 45 basis points off balance sheet. And assuming their market share remains the same, expected to remain around current levels, very key assumption. The rest of the financial profile is just called largely unchanged. We'd likely assign investment grade standalone assessments to Fannie and Freddie at conservative exit. But likely it would be a couple of notches, at least a couple of notches below the A1 standalone assessments of the clubs. Next step is we would incorporate the PSBA commitment if it still applies to new unsecured debt to arrive at an adjusted probability of default, an adjusted standalone assessment. We would then go and do a liquidity analysis, looking where, is there any additional classes in supporting debt, any debt, any preferred stock, to assign preliminary instrument ratings. And finally, we would assess the likelihood of implicit government support. And adding everything up brings us to that AA or higher rating that I basically mentioned at the beginning. I do want to emphasize that most of that uplift from that low investment grade standalone to that AA or higher on the unsecured is implicit support. So yes, even post conservatorship, outside if there's not an operational resolution regime, if their market share is still, very, very high, if it's still systemic, and there's no ability to have a, resolution where they continue to provide their critical functions. And the last thing, before I finish up on this question, is just touch on the MBS, which again, we currently do not rate. The MBS is secure. It's higher in the waterfall versus the unsecured debt. There's that far more outstandings, as Laurie went through. It is critically important to the plumbing of housing finance and mortgage finance. And we could argue it's more systemically important. And so again, believe that at exit, we think that it's unlikely that they'd be pushed out unless the market does review MBS as effectively governed.
So Warren, you said that you expect a conservatorship exit. The unsecured might be rated either at the same level as the US government or 1 to 3 notches below. You said this would continue to be driven by a very high likelihood of implicit support. What if the government makes it clear that, yes, we're going to release the GSEs from conservatorship with the PSPA lines of credit intact, but they won't bail out the unsecured debt? How would that change? How would that change your view? Or how would you look at that?
So our, assumptions for implicit support, largely driven once again is, by their systemic importance. It's by their market share. Is there a credible resolution regime other than a bailout? And so it's really, it's looking at that versus proclamations. It even go as far as, even if there was legislation passed that would prohibiting a bailout. Obviously, yes, proclamations are going to influence our view. Legislation is going to influence it even more. Influence our assumptions with respect to the probability of a bailout during financial stress. But again, if the entity is critical and there's no alternative but bailing them out, and even with legislation in a severely stressful scenario, and we've seen this playbook before, we would expect to see emergency legislation passed to facilitate a bailout. I do point to the banks. The banks do have what we view as a credible resolution regime. And so we don't ascribe like we would ascribe as far as the same level of probability of support to banks, that we do with respect to the Fannie and Freddie upon conservative exit. But for the 8, globally systemic banks, we assume a moderate probability of support, and that results in a 1-notch uplift in their ratings for deposits for bank level unsecured debt, not holding company debt, but bank level unsecured debt, 1 notch. Now, that credible operational resolution regime means there is some level of bail-inable debt, a substantial amount of bail-inable debt. If that is subordinated to the unsecured debt, that has positive with respect to reducing severity of the unsecured debt in the event of a failure. Maybe that has some sort of offset to a lower reduction in implicit support. But again, to really reduce that implicit support, we need that credible, in our view, to get rid of it, to reduce it, to eliminate it, or to reduce it, we need a credible operational regime. To eliminate it, the end of this means not to be systemic.
Thank you. So one of your competitors said they won't downgrade if the line of credit is intact. Is there a difference in the views between the rating agencies?
Obviously I can't, speak, to what a competitor said, but our view is that on conservatorship ship exit, even with assuming the PSPA remains intact and supports future unsecured debt, then yes, the unsecured debt could be downgraded, but still would remain highly rated.
Thank you. Michael, would you like to react to Warren's comments?
Yeah, sure. And again, oh, did I freeze? Can you hear me now?
Yeah.
Okay. Again, thank you for having me. It's great to be here. At a very high level, we are doing some speculative analysis here because we're not sure what we're reacting to. We're reacting to some public proclamations that they want to quote unquote privatize the GSEs. I still have yet to receive an adequate explanation of what a private GSE is. It seems like there's a little bit of an oxymoron in that terminology, but let's set kind of that, I guess, aside. We don't know if this proposal would have substantial PSPA line to it, if they would be making changes to the resolution regime, which paradoxically, as Warren pointed out, could actually further downgrade the unsecured debt. So these are things that we're reacting to, kind of like, I guess, the proposals that were percolating back in 2018, 2019, that type of thing. But we'll have to see, I guess, what they come out with now. There's no doubt that any of these actions, especially if they're administrative and they don't include something like what looks like a Ginny type guarantee where there's an explicit clear role for the US government, and then an explicit, this part can go under and become insolvent, these investors will be made whole, and then we're going to charge for it. There's really no doubt that absent that, costs go up. I mean, they have to. There's no downward pressure on rates, so they have to go up. It's a question of kind of how much, and that's when we get into this sort of squirrely discussion about the implied guarantee, especially on the MBS. I'll focus on the MBS, even though I know Warren was talking about the unsecured debt. Will they be downgraded? Of course, that would be a question. Would the MBS receive a difference in downgrade? Would there be a difference in the capital requirements for the banks that hold them? Would the Federal Reserve be prohibited from stepping in and buying these MBS kind of in a time of crisis? And then, very importantly, and this is one where, we're trying to do some research on this, but, the asset managers, whether it be an insurance company or a large asset manager or a central bank, who are the ultimate purchase of this MBS, they're fiduciaries to their clients, and they have to invest based on the rules that their customers give them. And so the outstanding kind of question here to me is, and one that we're trying to push up a pencil on, is if you did something like this and you say there's going to be a PSPA, but we're telling you right now that the government won't do anything more than that backstop, even though the prospectuses prior to the financial crisis said the same, and it didn't work out that way. But if you were to do that, when asset managers look through the rules that govern their ability to invest on behalf of their clients, if you're given special treatment to Fannie and Freddie Walston conservatorship, does that special treatment go away? And does it go away to the extent that you now have to divest of these assets? So in an extreme scenario, if you have a large asset manager with hundreds of billions of dollars that's available to invest in rates products, and a much smaller amount of money that they're allowed to invest in credit products, are we flipping agency MBS from a rates product to a rates/credit product? I think the answer is unclear, and I think that there's going to be a lot of going through these investor guidelines on the part of the asset managers who are fiduciaries, insurance companies who are regulated in terms of what they can buy. But it's going to be a lot of work with a lot of confusion and a lot of assumptions and a lot of trying to read through the lines. And I agree with Warren that they'll probably be ignoring of a lot of proclamations and more looking towards like actual actions in terms of the infrastructure set up to either resolve the enterprises or to make clear the government's role. So unclear on the outcome, but we do need answers to those questions. Would the rating agencies all look at it the same? Would foreign investors look at this product the same? How do asset managers who are fiduciaries change their investment mix, and how much pressure does that put on them? And I just think that if the administration is going to attempt to do this over the next, whatever it being 1 to 3 to 4 years, I really desperately advise that they go through a very methodical process of analyzing these questions before making a determination that, you know, this is free money that can be used for something else, because that'll all be very impactful in terms of how the spreads between agency MBS and treasuries ultimately shake out.
Thank you. Let me turn to Byron and then Steve. What do you think would be the effect on the way recap and release, the effect of recap release on the way the securities are traded? That is, would MBS investors have to change their risk calibrations due to perceived increased credit risk or liquidity risk? Any thoughts on how it would impact the TBA market? Any estimates on how much wider the securities would need to trade? Byron, why don't you
All
go
right,
first?
sure. And Steve, I'll let you'll plan on some specific number of how much wider. Let me say real clear after what's been said, you do not want to change the perception of these securities. We all enjoy a great benefit, and almost very few people I meet fully understand and can connect the saver through this secondary market with this agency mortgage-backed security all the way to how the housing market functions, the benefit the homeowner gets, and the overall benefit to the U.S. economy. And so I would urge not to create a change in that perception, whether it's the credit worthiness, changing the amount of investors that will invest in the security. The liquidity is extremely important. The TBA market is extremely important. And ultimately, we do not want to change this cost. To be frank and honest, even the Fed's balance sheet, as it sits here with the amount of MBS, it's not that big of a deal. They can sit there and hold that MBS portfolio, and we need the academics to stop talking as if it's something horrible going on with these securities sitting on their balance sheet. And since '87, I've never traded in this market without a large government balance sheet functioning in the market. First, it was Freddie Mac and Fannie Mae, and then it eventually became the Federal Reserve Bank. So let me emphasize, it will be, if you walk down what Michael said, be very careful, be very thoughtful, make sure you analyze this clearly, the impact. Do not believe you can just change the way these securities trade from a liquidity and perception perspective and think it will not have a huge negative impact on the U.S. economy. I think you're making a huge mistake with it. Steve, you want to be I'm sure you've got very specific numbers to put on this, and I want to speak to this from the perspective of an investor, a trader, and someone who has is money on the line, and someone who really believes in our housing finance system. So, Steve, I'll turn it over to you to be more specific.
All right. Thank you, Byron. Thank you to Laurie as well. Byron, you put me on the hook for probably the toughest question in the discussion.
I figured your answer would be, it depends.
Well, thank you for opening that door, Laurie. Yes, absolutely. You know, what I would say is I echo Byron's sentiments. For one thing, the TBA market is probably one of the most powerful innovations, not just in mortgage finance, but just in general in the U.S. fixed income market. It is an extraordinary tool, Laurie, as you pointed out, that allows lenders that are making mortgage loans to manage their risk extremely easily. And because they can manage that risk easily, their capital requirements are lower, more companies can be in that business, the competition to make loans goes up, and the price of mortgage money goes down. A lot of that is embedded in this discussion about TBA. If the GSEs, if we recap and release the GSEs, if they operate under their original charter, if they still have lines to the Treasury, then my guess is nominally the TBA market will stay in place. I think one of the issues is, how will investors feel, though, about the GSEs post-recap and release? Some investors, especially investors overseas, there's still scar tissue from the experience of 2008. And I think all we need to do is just look at the conversation going on now and the level of interest in this call alone. And there today is significantly more policy risk in the GSEs, especially after the 2021 Supreme Court decision that said the FHFA director serves at the will of the president, putting both FHFA and Treasury essentially under the control of the executive. For practical purposes, I think that makes the PSPAs much more of a political document. And I think regardless of what the letter of the law or regulation will say, investors are going to weigh those, especially non-US investors. So as you pointed out, Laurie, higher capital, let's say a more cautious investor base, the MBS should definitely trade wider. How much wider? Very tough to say. So Byron, I'm going to try to artfully dodge your specific question. Wider, definitely. Less liquid, I'd say definitely to that as well.
Laurie, can I say something about the TBA?
Absolutely.
Yeah. So you know, a brief reminder for everybody, and everyone on this knows, but I think it's worth kind of going through again. You know, we used to have Freddie Golds and Fannies, so we had two TBAs that stood next to Ginny. So you pull up your Bloomberg screen, you got basically three securities that you're trading. And there was always dynamics between how Freddies versus Fannies would trade, and sometimes that spread would be a few ticks, and sometimes that spread would be more than a few ticks, and that caused, you know, Freddie to have to do a bunch of stuff to keep liquidity in their TBAs, because, you know, to keep up market share, that part of the execution price that a seller servicer will go through in terms of whether they're going to sell into a Fannie or a Freddie, and that existed before the crisis. After the financial crisis and after conservatorship, that problem was exacerbated, so much so that Freddie had to do this, you know, G fee payback. I'm blanking on the exact word, but mapping, G fee mapping, where they had to change the G fees in order to make it the same economics to issue into a Freddie versus a Fannie. And this was a really convoluted system, but it was designed to make sure that we don't end up with just a Fannie at the end of the day, which is what would have happened absent, you know, FHFA letting them do that in conservatorship. And then the evolution of that was the UMBS, where now investors are meant to be able to buy both securities. They can deliver into them at the same price, and seller services can deliver into them at the same price. Investors are supposed to be indifferent between the two, and you don't have to do the G fee mapping. I struggle to see a world where these companies are, you know, released from conservatorship without clarity around the government's role, where that UMBS security can actually survive the way it is now. I think investors will then have to have a preference in terms of which bond they're getting, if they're going to get a Fannie or a Freddie issued MBS and to fulfill their futures contract. I think that, you know, companies can go under have problems for a lot of reasons. Doesn't just need to be the global financial crisis. We saw in 2005, 2006 hedging problems. You have accounting challenges. You can have an operational challenge. But all of a sudden, I think you're going to have a bifurcation of the UMBS market. And I'm not necessarily per se predicting this, but it's not impossible to see a world where that happens to such an extent that you end up with one GSE again. So you're really pulling at this thread beyond just the impact on rates, without clearly identifying where the government, you know, would stand behind on the MBS. You do open up that as a possibility, which I would think authors of, you know, privatization would not see it as successful if at 10 years from now UMBS collapsed and all you have is Fannie Mae because Freddie couldn't keep up with the MBS market. And as private companies, I don't think you can do this GV mapping. So that's just a little bit more weedy than what we're talking about, but it's a whole nother risk that exists in terms of what happens when you pull in the thread of the TBA market.
So thank you for bringing that up. I was going to actually bring it up a little bit later, but so I'm going to reverse the outline of what the participants have a little bit. But let me press on that a little bit. So basically, you're arguing that basically Freddie and Fannie during conservatorship have been sort of colluding, not competing with each other. They've aligned their policies outside of conservatorship. They would each choose their own path, and that alignment wouldn't exist. The securities would trade differently. So what does it mean? What would this mean for existing UMBS securities? And also, what would be the effect on the super pools in which Fannie securities are contained in Freddie pools and vice versa? Any thoughts there, or is this too speculative?
Oh, let me just add one piece in. I mean, you're going to have a bifurcated market, right? One, and it will price to the liquidity of the security. So the further you get along, if you don't want a bifurcated market, you don't want a market to separate because you will have less liquidity. And I believe that liquidity should be extremely important goal in whatever the decisions are made regarding the future of our housing finance system. So you created two different types of securities. You're going to end up with securities that trade less liquid than if you continue down the path of maintaining the system as is. And I think Michael's point is that it's very difficult to do this with these two separate entities. I think I think we really need to take that into consideration.
Laurie, let me jump in on this one. You would end up seeing that market trade to the worst case. So if you envision a scenario where there are two separate entities and you go down the path, which is one we've been down before, where one of them becomes credit impaired, even if the other is operating well, the TBA market's going to trade to the worst case. And in the case of existing UMBS, where you've got intertwined guarantees, presumably those would trade to the worst case as well. And in practical terms, the worst case means a significantly lower dollar price. I believe, to Michael's point, when Fannie and Freddie traded separately, there were times when they were nearly half a dollar price point apart. So you could see, again, liquidity get impaired and mortgage rates go higher just simply because the credit analysis would be so complex. And in that situation, the market just assumes the worst and trades everybody to that mark.
Well, thank you very much. Let's actually shift gears a little bit and talk about the impact on specific players. So we talked, in my presentation, I noted that depository institutions currently own about 35% of the agency MBS market, with roughly 28% of the market held by commercial banks alone. Government securities receive special treatment on bank balance sheets. In particular, they receive more favorable capital treatment and are exempt from the concentration limits of 15% of capital per entity. Steve, could you describe why these rules are important and what the impact of recap and release would have if the special treatment were to disappear?
Sure. In fact, your slide showed that between the banks and the Fed and foreign investors, 75% of the market falls under that umbrella. The banks and the Fed, in many cases, are investing in MBS, including Fannie and Freddie MBS, because of regulatory treatment. Those are unique attributes of the security. So on banks specifically, there are three special ways, actually, that Fannie and Freddie MBS get special treatment. One is capital. So, for example, for $1 in MBS on a bank balance sheet, the bank's going to hold 1.6 cents in capital. If the bank took those same identical loans and held them in its loan portfolio, the bank would hold 4 cents in capital. So MBS makes it much cheaper for a bank to hold mortgage risk. On liquidity, which is the second important thing, banks have been subject to liquidity rules since roughly the middle of the last decade. And banks have to show that they can turn enough assets into cash quickly to meet a bank deposit run. And Fannie and Freddie get the assumption under bank regulations that they are highly liquid. Now, they come in below bank reserves, treasury debt, they come in even below Ginnie MBS, but they are considered much better than other assets. So that's another reason why they have very special value. And then also you mentioned the concentration limits. So if we did recap and release, again, under their charter, again, with lines of credit to treasuries, my guess would be that technically they'd still qualify as government agencies. The benefits would be in place. But bank boards, management, regulators, they have discretion, and the institutional memory from 2008, the current policy risk around the GSEs, my guess is banks would have less enthusiasm than they do under the state we're in today.
Thank you. What about the Fed? If there's another, if the GSEs were released from conservatorship, if there's another crisis, could the Fed buy the securities? Or is this a tool that's apt to continue in the event of another crisis once they're out of conservatorship?
Yeah, so I suspect this is going to be one for the government lawyers, but I would assume that, again, with lines to Treasury, they would still technically qualify as an agency of the United States, and that would allow the Fed under Section 14 of the Federal Reserve Act to still buy the asset. I think the Fed has always bought MBS reluctantly. I have heard explicitly members of the board describe it as the most politicized asset in U.S. fixed income. That obviously hasn't changed. And the Fed has discretion. My guess would be in some kind of future crisis, if the Fed could meet policy goals with Treasury debt alone, that's the route they'd take. And only if they needed whatever available liquidity was in MBS, would they again resort to buying that part of the market as well.
Thank you. Michael, I'd like to turn to you in terms of foreign investors. They're major players in the market. They currently hold about 14% of agency MBS. Any thoughts on how recap and release would affect their purchases? Would they just buy more Ginnie securities instead?
Certainly some would. I had the honor and pleasure of selling Ginnies globally to central banks. It's some of those meetings were a lot of fun. Some of them were less so. You know, it reminds me of that story during the 2008 Olympics and the financial crisis where Paulson had to fly over to China and sit down with the PBOC and promise them that their investments would still be good. Will foreign investors accept some sort of wink, wink, nudge, nudge type pledge along those lines, or would they assume that that would be the case going forward? And I think they would split. I mean, I think, in my experience with Ginnies, the Japanese are particularly risk averse in this. In fact, almost every single meeting that you take with a Japanese insurance company or a Japanese official institution has to start and end with recommitting that and recommitting that the legislation is in place, that their stuff is government backed, and that there's no ambiguity or change coming to that. So this would certainly impact that as an investor base. The Chinese investors may be a little bit different. They might have actually, I think they actually play the spread a little bit. They have some former even GSE employees that are over there managing some of those funds. So a net, still a wider spread, and certainly a loss of some investors. Exactly how many, again, we get back to the exact same question of how much does everybody believe the implied guarantee versus believe the rhetoric that these are actually private companies, and then you're paradoxically back in the situation where the less market impact you've had, then the less policy impact you've actually accomplished. If you haven't really privatized anything, if the market isn't moving, if you really want to privatize them, you're going to have a huge global investor divestiture of these securities. So this is one last implore that I would make to anybody in the administration who's planning on doing this. Please have regular dialogue with all the investors, both foreign and domestic, to explain to them what you were thinking about the U.S. government's role, and listen to them in terms of what they say about how that would impact their investment, because I suspect a lot of people are starting to think through this, and they may not have answers yet, but that conversation is going to be critical to not massively disrupting this market. And one last point. There's doing this when the markets are calm, and then there's doing this in a time of disruption. Okay, so I think the agency market could handle, under conservatorship or with an explicit guarantee, a lot of disruption without spreads blowing out very much. But what somebody tells you when the markets are very sanguine is going to be different than potentially how they behave if there's a panic.
Thank you. We're actually running very, very long on this conversation, so I'm going to cut the Q&A. I'm going to ask Michael one last question, and then I'm going to give you each a minute to sum up. So Michael, the last question, and if you could answer in a minute or no more than 2, if the GSEs were released from conservatorship and spreads widened, origination could shift to the Ginnie Mae market. Alternatively, an exit from conservatorship could give the GSEs the ability to compete with the private sector in jumbo mortgages, etc. On balance, what do you think it would mean?
Yeah, I mean, I think that's the worst case scenario. I think that you could have a world where they go after all the super prime jumbo stuff that the PLS market and bank balance sheets are serving very well, and then they abandon their mission to lower credit quality communities, and all that stuff goes to FHA, and you end up in a world where Fannie, Freddie, and Ginnie are slash FHA are all just a lot bigger than they are right now. And I think that that would be, I don't think anybody could claim that as successful. That would be a disaster.
Thanks. So I'd like to give each of you about a minute apiece to sum up your views on the impact of recap and release on the overall functioning of the system and its ability to support affordable, accessible, and sustainable home ownership. We'll start with Steve, and then Byron, and then Warren, and then Michael. So Steve, you're on.
All right. Thank you, Laurie. And again, thanks to the Urban Institute and my fellow panelists. So we've talked about a scenario where we would recap and release the GSEs under their current charter with lines to Treasury, more capital. My guess is investors are going to continue participating under the assumption that government would ultimately backstop them as systemically important institutions. I think, to me, the question is, are we better off in that tomorrow than we are today? I think if you're a shareholder, the answer has to be absolutely yes. You're better off than where you are, certainly under conservatorship today, and you only need to look at responses in the common equity markets for a signal there. If you're a taxpayer, I think the answer is no, because you're taking risk and you're not getting paid for it. And then if you're a mortgage borrower, I think the answer is no again, because higher capital, more reluctant investors probably mean higher mortgage rates. Now, we haven't really gone into detail, but if you release the GSEs and then require them to buy a full faith and credit guarantee for their MBS from the US government, then I think things change. The shareholders are definitely better off than they are today. Taxpayers are better off because they're actually getting paid for taking the risk. And borrowers probably end up better off because I suspect mortgage rates would drop. And then finally, we haven't really talked about this, but some speculate that the reason for this conversation is that the government wants to reduce the footprint of the GSEs in the mortgage market. And if that's the policy goal, it would be much easier, less disruptive, less risky to keep the GSEs in conservatorship and simply raise guarantee fees. So of all the answers to the question, what do we do with the GSEs next, recap and release probably ends up being the worst of the reasonable alternatives.
Thank you. Byron?
I'm going to start where I began the call, is really recognizing the value of our housing finance system. And any ideas around change should start with, what exactly are we trying to correct? What problem are we trying to address? And let's make sure we understand the benefits that we enjoy today. The key to the housing finance system are those who have cash. The only ones that have cash are the savers. Mortgage originators don't have any cash. Banks don't have any cash. Government doesn't have any cash. And the only way the savers come to the table and at the right price is under the right circumstances. So if you want to change the circumstances, then be prepared to understand what the savers may do. They may not come back the way they've always come back. They may not come back at that exact price. And ultimately, the person that pays that price will be the American homeowner. So, and it's not, and again, let me also emphasize, so we always talk about the American homeowner being this great beneficiary of the housing finance system. The savers are also, at a time when baby boomers, so many aged participants in the US housing economy need income. So there's two sides of this, and it's very important to understand that. So I'm going to speak to it again from the benefit of our housing finance system. I appreciate our housing finance system. I appreciate the fact that I've got a 30-year fixed rate mortgage struck at 2.5%. I took as much money as I could take. That's a pretty big benefit. Couldn't do that in Europe. Probably couldn't do it in most places in Asia. So I'm pretty proud of it. So what I don't want is an academic who sits in a room, doesn't understand how these securities trade, coming forth with ideas that are not fully baked and fully thought out. That's I'll let Steve give the very specific technicals and the numbers, but I feel very strongly about being very cautious with the changes.
Thank you. Warren?
So that's also, which we haven't spoken about at all, which is a critical part today of the housing finance ecosystem, non-bank mortgage companies. The non-bank mortgage companies originate and service, majority, somewhere what, Laurie, 60, 65, 70% of all residential mortgages. Why are they able to do this? The vast majority, 90% plus of the originations and what they're servicing are agency and government-insured mortgages. Now, the stronger companies today are rated in the BA, BB range. Their financial profiles continue to improve. If, however, their share of agency and government mortgages declines materially, their financial profile would change dramatically. They'd have to have more liquidity. They'd have to have a greater level of capital. Banks really, they have the MBS book, and that's where they've obviously migrated from holding the mortgage directly, as Steve went through a couple of the benefits from liquidity and capital. Banks also, as far as in the resi mortgage origination business, especially mortgage banking business, and originating and selling, they don't really like the earnings volatility. Let's also not forget, how much you want someone with limited exposure of a 30-year fixed rate mortgage. Absolutely, fully are in the benefits to homeowners in the U.S. Economy. But for a depository which is funded with relatively short duration liabilities, deposits, the 30-year mortgage, you won't have it somewhat limited. So, and the last is just yes, obviously this is a very complicated system. It has a lot of implications on many players in the ecosystem, and potentially in a stress, market. We don't know, as Mike said, today might be fine, might only have a couple of basis points increase spreads in MBS market, but what happens in a stressful market on the overall economy?
Thank you. Michael, bring us home.
So quickly. These companies have been conservatorship for a very, very long time right now. It is not, I assure you, for lack of attempts at reform, for lack of legislative proposals, for lack of white papers, for lack of discussions. There's been a lot of them. I have a couple that are my personal favorites, but that's a tough conversation for a different time. But the point is, the reason that there's still a conservatorship is because we're pulling Jenga pieces out of the main part of the U.S. economy, and so that's I think why we're stuck here. So I urge respect and humility and caution as policymakers proceed.
Well, thank you all to our wonderful panelists. It's been a terrific event. I really appreciate the thoughtfulness of your answers. Our next event is going to be March 18th at 1 p.m. It's going to be conservatorship. We have David Brickman, Hugh Frater, and Don Layton, 3 conservatorship GSE CEOs who are going to explore the advantages and disadvantages of a release from conservatorship. That is March 18th at 1 p.m. We'll be out with the information within the formal link within a couple of days to register for it. Thank you all for joining us. And again, a special thank you to our 4 wonderful panelists. Really appreciate your doing this.